Want exposure to one of the fastest growing areas in the US? Like the idea of getting a market-beating yield and a double-digit dividend growth rate? Would you like a good deal on a great stock? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a major US regional bank with exposure to one of the fastest growing areas of the country. Banking. It's one of the world's oldest business models. This is a business model that dates back thousands of years. And why is it such an old and enduring business model? Because it's a great business model, one that can practically print money when it's firing on all cylinders. Even when it's not firing on all cylinders, it's still very powerful and very profitable. Lots of profits, which translates into lots of dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Fifth Third Bancorp, which appear to be trading at a significant discount today. Fifth Third Bancorp, stock ticker FITB, is a diversified regional bank holding company that offers a range of financial services and products such as deposits, lending, transaction processing, and advisory solutions. Founded in 1858, Fifth Third Bancorp is now a $29 billion by market cap major financial player that employs 19,000 people. Headquartered in Cincinnati, Ohio, the bank is mostly focused on its core Midwestern market that includes the states of Ohio, Michigan, Illinois, and Indiana. With total assets of just over $210 billion, they are in the top 20 largest banks in the United States. For context, there are over 5,000 commercial banks and saving institutions in the US. The bank operates four main businesses: commercial banking, 37% of fiscal year 2021 revenue, branch banking, 27%, consumer lending, 10%, and wealth and asset management, 9%. General corporate and other accounts for the remainder. There are few business models more enduring than the banking business model. Banking, as we know it, can be traced back to 2000 BC. It's one of the oldest business models around because it's one of the best business models around. Thinking in very simple terms, a bank can take in deposits at one rate and then lend at a higher rate. That's a good business in and of itself, but it's missing one of the most powerful aspects of the business model: the float. A float shows up in certain business models, including banks, insurance companies, and payroll processors. Whenever a large amount of low-risk, low-cost capital accrues as a natural course of doing business, and whenever you have a time delay between capital being taken in and capital going out, you have the opportunity to take advantage of a float and earn a substantial amount of money on this capital while it's in your charge. Warren Buffett has repeatedly pointed to the float for why he's so enamored with investing in banks and insurance companies. But wait, there's more. In addition, modern day banks have branched out into areas like wealth management, financial services, and payments. This further diversifies banks, all while giving them access to more capital and recurring fees. And all of that leads to increasing revenue, higher profits, and bigger dividends for the likes of Fifth Third. Already, the bank has increased its dividend for 11 consecutive years. They're off to a great start with a 10-year dividend growth rate of 14.8%. Better yet, you're pairing that double-digit dividend growth with the stock's current yield of 2.9%. That's a rather compelling combination of yield and growth, in my opinion. While this yield is only right in line with its own 5-year average, it blows away the broader market's yield. And since the payout ratio is just 32.2%, this is a well-covered dividend positioned for much more growth ahead. I like dividend growth stocks in what I call the sweet spot spot, a yield of between 2.5% and 3.5% paired with high single-digit or better dividend growth. This stock is squarely in the sweet spot. Looking at business growth, Fifth Third has advanced its revenue from $6.1 billion in fiscal year 2012 to $7.6 billion in fiscal year 2021. That's a compound annual growth rate of 2.5%. It's been a challenging decade for banks. I see this as a very acceptable top-line growth rate. Meanwhile, earnings per share increased from $1.66 to $3.73 over this period, which is a compound annual growth rate of 9.4%. That's fairly impressive. Better profitability has helped here, but a lot of excess bottom line growth has been spurred by extensive buybacks. The outstanding share count is down by 25% over the last 10 years. Looking forward, CFRA forecasts that Fifth Third will compound its earnings per share at an annual rate of 4% over the next 3 years. What's perplexing here is that CFRA had this 3-year EPS compound annual growth rate forecast at 19% when I last looked at their report on Fifth Third back in August 2021. CFRA has materially peeled back the growth forecast despite no matching material change in Fifth Third's business, so I find it inexplicable. Even stranger, CFRA has simultaneously increased their 12-month target price on the stock by a material amount. Admittedly, the macroeconomic backdrop has deteriorated since August 2021. A very high rate of inflation is forcing the U.S. Federal Reserve to become aggressive with raising interest rates, which could run the U.S. economy into a recession. At the same time, higher rates generally benefit banks. I think it's important to keep in mind that the last decade has already been a tough stretch for banks. The U.S. economy hobbled its way out of the Great Recession, interest rates have been kept at historic lows, the regulatory environment has been challenging, and then a global pandemic happened. Yet Fifth Third still put up a very respectable EPS and dividend growth over that stretch. In addition, Fifth Third has put itself in a stronger competitive position in recent years by aggressively expanding into Florida. Florida, which is one of the fastest growing states in the US, has become one of the bank's largest markets. Even if the next decade is tougher than the last decade, I don't see why Fifth Third can't produce high single-digit EPS growth. With a low payout ratio, the dividend could grow at a level that's at least in that same range. And with a starting yield at almost 3%, it's hard to complain about that. Moving over to the balance sheet, the bank has a rock-solid financial position. They have total assets of $206.3 billion against $183.5 billion in total liabilities. Credit ratings for their senior debt are as follows: BBB+, S&P, Baa1 Moody's, and A- Fitch. Profitability is fairly robust. Over the last 5 years, the firm has averaged annual net margin of 30.9% and annual return on equity of 11.9%. Net interest margin came in at 2.6% for fiscal year 2021. This is a high-quality enterprise pretty much right across the board, and the company does benefit from durable competitive advantages that include economies of scale, a large float, switching costs, and built-up relationships. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. In particular, regulation is a constant challenge in banking. The U.S. Federal Reserve is anticipated to aggressively increase rates throughout 2022, but rates are still low by historical standards. All banks have direct exposure to economic cycles, and the current cycle is especially uncertain with unknown residual impacts from the pandemic and lockdowns. With the U.S. Federal Reserve embarking on a mission to curb demand, the near-term odds of a recession have risen. A recession can hurt the bank in two ways. Less economic activity reduces growth from deposits and loan demand, while loan losses harm the balance sheet. These risks should be thoughtfully considered, but I still believe this bank can make for a great long-term investment. With the stock down nearly 20% from its 52-week high, its undemanding valuation makes it even more enticing. The stock's PE ratio is sitting at a lowly 11.0. That's substantially lower than the earnings multiple of the broader market. Admittedly, it is right in line with this bank's own 5-year average price-earnings ratio, but with rates rising and the prescient expansion into Florida, the bank arguably deserves a higher multiple than its long-term average. Banks are also often valued on a price-to-book ratio, with most banks commanding a PB ratio that ranges from 1.0 to 2.0. The stock's price-to-book ratio is currently 1.4, which is on the lower end of that range. And the yield, as noted earlier, is right in line with its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. The 7% mark is well below the bank's demonstrated EPS and dividend growth rates, respectively, over the last decade. Rates are rising to the bank's benefit and the payout ratio is low. However, I think some caution is warranted. The near-term earnings per share growth forecast is below this number. The current economic cycle is fraught with uncertainty, and near-term odds of a recession are seemingly rising. Overall, I think this is a fair assessment of the bank's long-term dividend growth power, even if it might be a bit bumpy from year to year. The dividend discount model analysis gives me a fair value of $42.80. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts with future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Fifth Third as a 3-star stock with a fair value estimate of $43. CFRA rates Fifth Third as a 4-star buy with a 12-month target price of $56. I came out within pennies of where Morningstar landed. Averaging the three numbers out gives us a final valuation of $47.27, which would indicate the stock is possibly 15% undervalued. Here's the bottom line, guys. Fifth Third Bancorp is a high-quality regional bank that has done really well during a challenging decade. Climbing rates and a more favorable geographic footprint set the bank up to do even better over the next decade. With a market-beating yield, double-digit dividend growth, a low payout ratio, and the potential that shares are 15% undervalued, this is a stock that long-term dividend growth investors should be able to bank on over the long run. And now for a special news announcement. Microsoft Corporation, stock ticker MSFT, just won part of a cloud mega deal from Boeing. I've covered the tech juggernaut so many times on the channel, I've lost count. If Microsoft isn't already in your portfolio, you really ought to consider changing that at the first chance you get. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.